Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, welcome everyone. You're listening to Your Money Momentum. My name is Tom Kennedy. I'm here with Kevin Curley for our mid-month podcast. Kevin, what's up?
Long time no see, Tom. Just getting ready for Thanksgiving.
Can't believe it's already the middle of November. Time's flying by, and Mr. 5,000 on the S&P. You got a ways to go before we get there.
We're getting pretty close. I don't know what you're talking about.
6 weeks.
We're only like 10 or 12% away from hitting that big number. And Santa Claus rally starts, I think, a few days before Christmas. So we might be right on track to hit where I need to hit.
Well, we'll see. Yeah, it starts about 5 days before the end of December and goes into the first 2 days of January. So you're gonna need some big returns at 5,000, but we've seen crazier. So let's.
Hey, we're on our way today. Market's up big today.
It is up big today. Still not over though. Let's jump into
the day or the year.
Yeah, both. It's like college basketball. You only watch, March Madness. You only watch the last 30 seconds because it's the first.
See how it ends.
Yeah, the first part's irrelevant. Let's do our central bank roundup. We'll jump into a couple role plays, and then we'll end with our 5 good minutes on some end of the year tax planning ideas, strategies, and also some changes that are in store for 2024. So let's start where we usually do, central bank roundup.
Shine those boots. It's time for
Doggy.
Central Bank Roundup.
The topic of the day, quarter, year, 2 years, last 5 years, the Fed, higher for longer. What are your thoughts?
Well, I always like to go back to our buddy Nicky T, which somebody needs to let him know we call him that, I guess. But he's got an article at least once a week, sometimes twice a week, basically talking about what Powell's going to do next. And so, the most recent comment was last Friday. He said Powell stays cautious on next rate move. So there's no commitment from the Fed to say it's over. Inflation is still over 3%. Their goal is to get down to 2%. So I wouldn't be surprised if the chairman says we need another hike, maybe a second hike in 2024. And, you see rates, at least for the Fed funds rate, go a little bit higher before they drop. This is after seeing, and let me be real clear about one thing. If he does another quarter point, he ties Paul Volcker for most rate hikes in a single cycle. If he goes for 2, he gets to break the record. So he can go down as the most aggressive Fed chair of all time. He's just 2 hikes away, Tom.
Yeah, he has no idea what he's going to do. I'm convinced he doesn't know what he's going to do until about 30 minutes prior to the meeting. And I feel like they have a dartboard on the back of their room before they walk out to figure out what they're going to do. I mean, they got it wrong the whole way up. I think they're going to get it wrong on the way down. And I think he's done. You saw the inflation numbers come out this morning. They looked really good. They looked encouraging. But I think it's going to come down to, how long he stays up there. If he hikes again, I think it could get ugly for the equity markets. I don't think the markets are not expecting it. The markets are expecting that we're going to get 3 to 4 hikes by this time next year. So, and I typically like to follow the bond market over what I think the Fed and the FOMC is forecasting, because they just were. I mean, they couldn't have been more wrong over the last 3 years. I mean, it's just not. It's laughable. It's not even.
Yeah, if you use the 2-year as where rates should be, it's 4.8 this morning, down 20 basis points on the day. So a pretty big drop, but that's basically a quarter point cut. And it's really 3 cuts from where we are now, from if we're using 25 basis points, which for whatever reason they do. They never do 12.5. They never do 37 basis points. They just go 25 at a time. So however they settled on that number, that seems to be what they do. I would contrast that with the ECB, who is in the news all the time. So they paused at their most recent meeting, but they put it in the papers every day for a week prior to actually making their announcement. So there was a very little reaction to their change because their policy had been very clearly communicated through what they call job owning, and just letting people know, hey, the Europeans, we're about to do this. And they told them every day. And then when they finally had the announcement, oh, okay. Versus the Fed kind of has been, yeah, we think we're done. We're not sure. Maybe we'll keep going. But I would say, like you did, like, he decides 30 minutes before the meeting what's going to happen. Now, they do vote. So he's not actually the one deciding last second. But it does feel like it's a little bit more the meeting is where they make the decision, as opposed to we all come to just check the box that we all agree. We talked about what we're going to do and we're going to go do it. So I'm not saying one is better than the other, but we've
Well,
seen dovish talk out of the ECB already. The Bank of England has made it clear they plan to cut rates next year. You've seen corresponding drop in their bond prices.
Well, it's like all these countries have to keep up. They can't be, unless you're Japan. Japan just did its own thing, but you can't get
Let's
your
save them for
currency
last. That's a
devalued.
great story.
And you can't devalue your currency. You have to hike when everyone else is hiking. So now it's this game of chicken: is who's going to cut first. And I think it's the team with the worst balance sheet. If we continue to hike, we are going to mathematically bankrupt our country. I mean, the interest carry on debt last month was 76 billion. That's annualizing 900 billion just in interest carry, almost $1 trillion a year tacked onto our, where are we at, 33 trillion and counting. It's just going to
It's a lot.
snowball. I mean, they can't do it. Like, they literally can't do it. They mathematically can't do it. I mean, I guess they can just keep writing IOUs, but I think we're going to be the first to cut, and I think you'll see all the other countries follow suit. But we are in much worse shape, in my opinion, debt to GDP ratio, than a lot of other countries out there.
Yeah, and we're well above where we should be. 70, 80 in a good economy as far as debt to GDP seems more appropriate with history than being, 120 and having all these budget deficits. So I think have some fiscal changes. We'll see. There might be another shutdown before the end of the year here in the U.S., but I don't want to bury the lead. Let's talk about the Bank of Japan. They are the ones who are making all the noise, and you can see it play out in currency markets. And then most recently, you can see it play out in expectations for equity. So this week, you had multiple big kind of wirehouse firms like Morgan Stanley, UBS, all those come out with their predictions. JP Morgan had their long-term capital markets assumptions. And one of the themes I found was Japanese equities seems to be something everybody's in favor of. And I think it's a currency play as the Bank of Japan unwinds their tight yield curve control and let things kind of go. That's just going to drop the currency. So if you're an American or you're outside of Japan and they have weaker currency, that can be helpful because they can export more Toyota vehicles, they can export more TVs from Sony, they can do a lot of that. And Japanese equities might be something that does well over the next cycle as really they just destroy their currency.
Yeah, no, I actually agree with you. They didn't hike like everyone else did. I think they're in much better shape. We won't mention them because we can't, specifically the investments, but there's a lot of ETFs out there to play just what you're talking about, to play Japanese equities, and I think it's something to take a look at, and just international in general. As the dollar started to decline, you're starting to see that in the last, call a couple of weeks, and that correlation's back to the dollar and the equity markets in the U.S. I think international markets, in particular Japan, is looking more and more attractive.
Yeah, and they're going to let market action take place. So, the specific example they said is, they've had this policy for 7 years where they held down Japanese government bond yields artificially low. So, for example, they made a policy change. The 10 years now going to be allowed to rise above 1%, which is a major change. And so I don't know. I think that hurts the currency for sure. And they've in the past had to do currency interventions to stop it. Last summer, we talked about some of those, and now they've let it blow past 150. It's kind of found a settling place then. And anybody who thinks those numbers sound silly, I would just encourage them to change the decimal point to say, well, it is 150, but if you've been to Japan, they don't have a lot of things priced $1.50. It's priced at 150 yen. So if you just say every dollar is $1.50 yen, and in your mind move the decimal point, it doesn't seem so. The numbers don't seem so silly. But either way, it's a very weak currency. It'll help their economy out for export, which has really been their focus for 40 years.
Yeah, no, I think, you look at real rates, which is interest rates minus inflation. We're positive, and based on
Yeah.
where based on CPI being being forecasting at 3%. We're at what, 5.25, 5.3. We got over 2%, and that's what Powell has mentioned in the past on is this real rate. What's that delta? What's that cushion? What's the number? And they have no idea what the number is, by the way.
Well, their thing is they call it R star,
Yeah.
which is what's the neutral rate of money, basically to not hurt but not encourage. And they don't know the number. That's why they call it R star instead of 5%. Is they don't know what that neutral rate is, and so they're trying to find it. What we've seen in other countries is when they get above 2% real rates, that's where you start to really kind of see things draw back. If you get higher than that, things come streaking to a halt. So we'll see. I think the first one to cut is going to be the Bank of England. I think the ECB will go next, and the Fed, for once, might be the last ones to cut. Last man standing on that one. And yeah, you're right. It's going to hurt the fiscal situation. So get ready for some questions about independence of the Fed coming to you soon.
R Star. It reminds me of what the Enron traders were calling their special purpose vehicles, Death Star. I don't know if you've ever seen the smartest guy in the room.
Oh yeah, it's been a while, but it was great back when I saw it. All right, Tom, let's go see Let's go see who can we pretend to be. All right, we're bringing you a little bit of role play. Tom, I think we've got five today, so I'll let you pick from your favorite on the list of where you want to start.
All right, let's start with let's start with you. You're Jamie Dimon. It's been a lot of headlines, you've been all over the news about selling your shares, not all of them, but a good amount for the first time ever since you've been chairman. I think it was back in 2005. Why? Why are you selling? What do you see that the rest don't?
Well, look, Tom, you have to understand. This has nothing to do with whether I believe in the company or not. Obviously, I believe in the company. I've never sold a share of stock since 2006. I was brought under Sandy Weil. I took a blood oath when I was with him at Citigroup. I wouldn't sell a share until I left. But look, I've gotten older. I've got to do some estate planning. I still have, $1.2 billion. It's not like I'm selling all of it, but my plan is to sell about 143 million dollars of shares in 2024. But I'm not alone. Look at some of my lieutenants. They're all selling shares. I didn't make them take a blood oath. I mean, you got Mary, Danny, Douglas. They're all selling shares. So everybody at JP Morgan is selling shares. But we're not alone either. Guys over at Morgan Stanley are selling shares. Goldman Sachs are selling shares. But no, don't take this as anything to do with the company. Grass is always green. If things are going higher, things are going to be great. It has nothing to do with anything. I just I need some liquidity for some estate planning.
Does it have anything to do with you being 67 years old? And when you started with JP Morgan back in 2005, it was $30 a share. And what are we at? 100?
Well, you got that wrong because I started with Bank One. I created JP Morgan in its current state. Without me, this thing would still be based in Chicago. It would be a cut rate bank. I've created it into the #1 financial services company in the world.
Wow.
So yeah, I'm going to sell some shares. Deal with it.
All right, Jamie. Your 2.8% dividend isn't cutting it anyway. I'm going to Morgan.
Yeah. Well, Tom, I think it's time for us to go see what's up in innovation. You, my friend, are Cathy Wood. You are the Chief Investment Officer at ARK Invest. You recently sold shares of NVIDIA, saying it's priced well ahead of the curve. Then it had a knockout 9 days up in a row. It's just a percent or so from all-time highs. You've always owned things at high PEs or some bunch of companies with no earnings at all. And don't you have a bunch of Bitcoin as well? Well, what's going on here? What about those next-gen chips? Why are you selling all these NVIDIA shares? Do you not believe in the innovation future that you promised us all?
Listen, we're a tactical fund. It's not a passive strategy. We love innovation, and that's what we invest in. But when you have stocks that you own that are up 300-400% like Nvidia, you need to take some chips off the table. And yeah, I'm a big believer in cryptocurrency and Bitcoin. In fact, I just sold 6 million worth of shares that were up over 250% year to date, which is why my returns on my fund are starting to rebound. So we look for value. We like to lock in gains when it's appropriate. We like to rebalance the portfolio, invest in innovative, disruptive tech. We don't care about cash flow. We never have. We never will. We just want innovative technology that we think is going to be disruptive over the long term. And that's exactly what we're doing. And don't look at my my returns over the last 5 years. That's ridiculous. Just look at the last couple of months, and you'll see exactly why we had investors piling into ARK Invest. I don't like Cathy Wood, so that was a bad one to give me.
Oh, that's why I gave it to you. You had to make the case. It was a good case too. All right, who are we talking about next?
All right, let's talk about AI. Open AI. Sam Altman. He's been all over the place. Bloomberg recently said that OpenAI was valued at 60 or 86 billion. Made a big splash with the ChatGPT. Allegedly has over a billion in revenue. I don't know if it's profitable. I don't think it is. But what is it? What does the runway look for you? What is the next trick? What's the next profit revenue? What does the future have for AI?
Well, have you heard about ChatGPT 4? We're going to roll that out. Tom, you can submit a prompt to me. It can be 300 pages of text, and my AI bot will go and just do it. Have you heard about custom chatbots? We got a lot of, things we're doing. So let's say you want to go on a vacation and you say, I want to go to, we'll call it South Florida. You'll just tell the AI bot, I want to go to South Florida, book me a flight in the seats that I like, to the hotel I like, book me a hotel reservation, book me restaurants. I want to go to the movie at this time. And you'll enter that as a prompt. And a few moments later, we'll have your itinerary for you. It'll all be booked. Your haircuts will be scheduled, your spa services, whatever you want. So we're going to make your life so much better. The consumer is about to go through its next frictionless society movement. So that's why we had our valuation go from 29 billion in April to 86 billion this month. It's all completely justified. And look, I'm not in it for the money. I've already made all my money. I was an investor in Stripe. I was an investor in a lot of other VC funds. So for me, this is about moving the world forward. It's not about that. That's why I took a private foundation and turned it into a for-profit company.
Wow, that sounds a lot like someone who just went bankrupt recently. WeWorks. Weren't they? Didn't they have $1 billion valuation and it went straight down?
Yeah,
What are
but we
you
have
guys?
$86 billion valuation.
Wow, and you guys have an $80 billion valuation. You got a billion in revenue, and you're not profitable. How does that? How do you change?
Well, look, the internet, when it first came along, people didn't know what it was going to be worth. And, it's a lot like that with AI. Look, there's a lot of promise. There's going to be some stunning growth. Did I mention that we're going to allow some of our staff to sell stock during our next fundraising round? So, we're providing liquidity. We're making people really wealthy.
Well, I like it, Sam.
All right. Tom, you are Steve Schwarzman, which you said in August for quote, those of you who are not financial people, it doesn't get simpler than lending somebody senior debt and have the security of all their assets and make 13%. How wonderful. The outlook for bonds and credit seems bright, but many experts told me a year ago bonds were the thing to boot, and they lost more money this year. So why should I believe you now? Why is the sky not falling? Why are you crying wolf again? 2023 was going to be the year of the bond, but yields broke multi-decade highs. Why is
Well,
2024 going to be any different?
Well, let's just make one thing clear. Bonds haven't lost any money. In fact, if you've sold bonds during a rising interest rate environment, sure you've lost money. But if you're buying bonds, you're looking really good right now. And private credit looks even better. 13%. I would take that all day long. I am at the top of the capital structure with senior debt. If you don't make that 13% payment and you default, I'm now I added more real estate to my overall multi billion dollar portfolio. 13% I will take all day long. It's getting harder and harder to get capital in the market from your traditional sources like banks. So you're going to have to look towards private credit, and that's where rates are at right now. And I will take that bet all day long, and I think it's going to be a continued trend. And if you know how to play that market right, you're going to make a lot of debt in the private credit market.
Okay, so 2024, year of the bond.
2024 may be the year of the bonds. I think you may see rates come back down. If they're at an all-time high, you're going to have high coupons, and if it's a coupon plus trade, you're talking low double-digit returns. You have what 5, 6, 7% on corporate credit. Plus, if you get a drop in interest rates, you'll pick up on the spread and duration. It could be the year of the bonds. We could see it could be 2014 all over again. This could have been a longer term taper tantrum that we saw in 2013, and the best investment you could have bought in 2014 was long term treasuries up almost 35%. So I think 2024 might be the year of the bond.
All right, thank you, Steve.
All right, let's do our last one. Venture capital, Mark Anderson. So valuations are
Andreessen, the disrespect you give me, unbelievable.
he's tomato. Valuations on venture-backed
I'm a legend,
companies
Tom.
nearly collapsed over the past 2 years. What's going on in the VC market? Rates were at 0%. Capital was cheap. Anyone could borrow. Anyone could reinvest. Now you got rates at 5%, risk free. Is it still attractive? And what does the growth look like in the VC market?
Look, Tom, you have to ignore that whole crypto thing, and let's not talk about metaverse investments. Let's ignore some other things, but let's really like the focus. You just heard from my friend Sam Altman. AI is the next big thing. Now, if I'm Mark Andreessen, what I have to tell you is give us a real world problem, and we can invent technology that will solve it. Uh, the last 2 decades, yeah, it was a little more favorable. 0% rates, pretty helpful for startups because, our profits will eventually emerge. But if it doesn't happen for 20 years, you weren't going to make anything in bonds anyway. So why sit in a money market making zero when you can have it all, be in a VC fund? So I think things will be just fine. Um, Look, technology is going to eat the world, as I predicted in a paper 20 years ago, and it's continuing to do that. And we're going to go solve. Have you had your first driverless car experience yet? Have you seen us mining on asteroids? Technology and venture capital, we're the way forward. We are the seed investors. We get all the new technology off the ground. I mean, AI, but who knows? There's could be tons of new things we're going to do next. So no, I don't think that 0% rates was the only reason we did well, and I don't think that the next 2 decades are going to recur. But we're going to still solve problems, and that's where we really created value. Nothing to do with 0% rates.
All right, Mark Andreessen. A lot would beg to differ, but time will tell.
All right.
All right,
Well, that
let's
wraps it up for role play. We're gonna go. Let's go talk taxes and end of year planning.
all right, let's do it. So let's start with end of the year planning, and then we'll talk about some changes going into 2024. So we're at mid of November. We got 6 weeks left of the year, which is crazy to even say. Any thoughts, strategies on taxes, just in general, Kevin?
Yeah, the first thing is, if you haven't been doing it throughout the year, tax loss harvesting, it's time to go through and see maybe some of those bonds or some of the bond funds or even some of the stocks that you own that weren't part of the Magnificent Seven have not done well. Well, you can take up to $3,000 against ordinary income with those tax losses. In addition, it can improve the tax efficiency of your portfolio if you were to sell, let's say, a small cap mutual fund and buy an ETF, as long as it's structurally different and isn't, a like kind investment, you can switch those out, and now you have a better tax basis. The second thing I would say is RMDs. If you have not done your RMDs for the year, make sure you do that. It's a very punitive penalty if you don't get it done before the end of the year. Those would be my first two. What do you got, Tom?
No, I think tax loss harvesting is underlooked and should be taken advantage of. Even if you don't have any taxes that are going to be due this year, it can carry forward to your point. So, and it's as easy as if you own a stock, let's say you own Exxon. Well, you can sell Exxon. You have to wait 30 days to get back into it, or it's called a wash sale. Or you can just buy Chevron the same day, which is, again, not the same stock, but it's the same sector.
Highly
And
correlated.
highly correlated, and you can do the same thing with ETFs. There's a biotech ETF with like four different companies, and they feel the exact same. They just have different asset managers behind it. That's also allowed to do, where you switch out the same ETF that second with another ETF to just carry forward that loss, because the tax delta and the tax savings it starts to add up after a while. And when you have an after tax account, it's all about net return at the end of the day. So if you're in a higher, especially if
Yeah,
you're in a
and
higher
look,
tax.
the tax loss harvesting, as far as a percentage gain on your portfolio, it's incremental, it's marginal. This isn't some breakthrough idea. This is, on the margins improving your portfolio. So it is important to do. If you don't do it, it's not the end of the world. But we're all in it for 30 or 40 extra basis points. That can make a meaningful difference on long-term returns. So the next thing I would mention is charity. If you're planning to give, try to plan it out before the end of the year. You can work with an advisor like Tom or myself, and you can go through and say, would it be better to give this year or next year? And we can go through your tax planning and say, okay, well, this makes sense for you to do it now versus, in 2024. Maybe it it doesn't make a difference either way, but one thing to consider is if you have a big income year this year, making a bigger charitable donation this year to offset that, especially if you think income might be down next year. And there's a few ways to do it. One, you can do it with cash. Two, you can do appreciated securities. You can do artwork. You can do jewelry. You can donate a lot of things. And one vehicle that's very helpful is called a donor advised fund.
Yeah, and I don't want to. We could probably take a whole episode on a donor advised fund, but it's just you can donate as much as you want to it that year, and you get the tax write off, and it's especially good for to your point if you have a big income year, or maybe you sold a business, and you want to have charitable intentions down the road, but just don't want to write a massive one time check to a charity. You write to the donor advised fund, and then you let that investment grow within it. Then you can take at your time, you can to your charity of choice, you can do it on a monthly basis, annual basis, doesn't matter. It's out of your state. You got the deduction for that big income year. And it's a great resource. And you can just Google donor advised fund, and there's a ton of resources on it, and they explain it pretty well.
Yeah, there is a limit on how much you can donate. It's in some cases, depending on what you donate, it could be 30% of your adjusted gross income. In other cases, it can be 50% of your adjusted gross income. But just like tax loss harvesting, if you're above that, you can carry forward those charitable deductions in that excess until you exhaust them. So if you do donate too much and you don't have the AGI to support it, we'll just carry forward. You can do that deduction next year.
Yeah, so let's talk about pre-tax accounts. I think this is an important time to look at your 401ks, to look at your IRAs, and to make sure if you have the means or if you have the intentions to max them out that you're there. For this year to max out your 401k, it's 22,500, an additional 7,500 if you're over the age of 50. For Roths and traditional IRAs, it's 6,500 for this tax year and 7,500 if you're over 50. And for the IRAs and the Roth, you have until tax filing of the following year, so April of next year, to contribute to those plans, but the 401ks you don't. You have to max those out by December 31st. It's easy to do. If you're not there and you want to max it out, you can call your benefits group or your HR and have them increase your deferral option. Usually takes one pay cycle to kick in and try to max it out before year end.
Yeah, and I think one thing to mention is that it can help to work with either a CPA or a advisor like ourselves to figure out, does Roth make more sense, or does the pre-tax doing traditional IRAs or at work, your 401k, either traditional or using the Roth. The kind of rule of thumb is if you're in the low 20s for your tax bracket, it's kind of a gray zone where it might make sense to do one or the other, and that's where advice can come in helpful, is actually looking at your unique situation, helping you with that. But if you're in a very low rate, let's say the 10 or 12% rate, Roth tends to be a better thing for you, and hopes that your rates in the future will be higher. And it's the opposite. If you're in the 37% tax bracket, you want to get as much pre-tax money in there as well, because you can make that part go away. Then you're only paying 35 at the highest level. So, if you need help going through the progressive tax code and how it impacts you and where to do that, we can help. A CPA can help. There's some good information online as well.
Nope, very good. Let's talk quickly and end on what are your thoughts next year for taxes? You want to talk quickly about just some changes that are taking place that we know about?
Yeah, so the contribution limits that you just mentioned, for 2024, the 401k goes up $500 to 23,000. Plus you can do 7,500 if you're 50 years or older. And for IRAs, it also goes up to 7,000, up from 6,500. So both of them going up $500. And again, you can add more if you're over 50. So that's a big one. One we've talked about before is the expiration of what's commonly called the Trump tax cuts. There's some major estate planning and gifting that you can do, that you really got to get done either 24 or 25. We don't know what will happen with that afterwards. But what's nice is that we've had a threshold increase of 5.4%, as reported in the Wall Street Journal. The tax brackets are jumping. So one of the, I guess, good problems of inflation is that now if you made a little bit more money, your bracket has expanded. So if you're thinking about, maybe I can take income in December versus January, it could be advantageous if you have the ability to delay that income or recognize that income, to recognize it for next year, because the brackets are jumping, and that means you pay lower taxes overall.
Yeah, that's a good point. It's a really good point too on the sunset of Trump's tax law, which ends end of 2025, so beginning of 2026. So we have remaining this year, 24 and 25, and there's some hefty reductions that are coming down. So if you have estate planning needs and means, please reach out, because there's planning needs to start now as opposed to waiting to last minute for those tax benefits.
Yeah, and the standard deduction is going to go up a little bit next year as well, and it should be a little bit higher in 2025. But then that thing's getting cut significantly in 2026 unless Congress takes action, which, as we've seen from this year, they're not great at taking action. So I'm not sure that anything's going to happen except expiration. So making sure you maximize your deductions if you're going to do it itemized, or figuring out whether standard or itemized is better for you is an important thing to consider. And at the end of the year, you have a pretty good rough estimate of what your income is going to be, and you can make decisions like Roth versus traditional, and know, okay, I made the right one for this, or hey, do I give now or do I give next year, or do I, find a couple other strategies to minimize my tax burden. So lots to do for the end of the year. If you have a good advisor, hopefully they already told you about this stuff. If not, give Tom a call. He'll be happy to help.
All right, Kevin.
All right.
We'll wrap it up
Talk to you later.
there. Thanks.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.